It's really exciting to have you here because we've been talking quite a bit already about tokenisation, and obviously tokenisation of real estate is one of the key kind of use cases that gets talked about a lot, but not necessarily in terms of practical implementation or action, more often in a theoretical sense. So you're doing a lot of exciting things, I know, and this is part of a series of kind of dialogues that you're going to be having now. You've already had a couple and you've got some more things coming up. So for starters, can you just outline a bit what it is you're launching and why?
Okay, well, I think first off, we're moving away from the theoretical, which is the lovely thing. For 7 years, and in the liberal world of the blockchain, when it first started to create itself, there is this agenda that wouldn't it be good if we could just work out a way to make property, in our case, a liquid tradable asset class. Property was always the genesis of this. And for many, many iterations and many durations, we're always looking to see how we could do that. There have been a number of false starts. There's a lot of stakeholders. There's compliance, there's regulation, there's prudential. There are a lot of people to keep happy in this audience. So our particular journey started in 2016, and we simply started to build blockchains for existing businesses, pharma, logistics. I'm an ex-logistician. And then we started to realize where the greater value sat. And the greater value sits with real estate in a liquid tradable format, not only in terms of us as property owners of being able to access the equity that's trapped in our properties, but also be able to use that in buying that Starbucks coffee. And that systems approach, that end-to-end systems approach, that's new. About 7 years ago, I was telling some of the people that were here this morning, 7 years ago we attended, with Michael Manelli's blessing, one of the halls where they were just starting to showcase blockchain for the first time. There were 29 companies there. Of those, 28 were doing a linear engineering of what was done before. All good, all efficient. We can see in our back end of a lot of our systems and banks and systems now that we're getting efficiencies. There's only one company there that actually was remarked at the end of the day by someone who'd done an enormous amount of analysis on all the companies there that actually proposed a new value proposition. Now, if the UK is going to succeed in the future in the post-stablecoin environment, it needs to make sure that it has something that the world wants to buy. And so the asset-based economy, we think, is what's coming. We've done a lot of modeling on this one. We've looked at macroeconomics, we looked at long cycle economics, and our view is we're moving to an asset-based economy, and that's what we prepared our company for.
Yeah, so, I mean, super interesting, and I think a lot of people in the audience are probably aware of some of the sort of technical benefits of tokenization in terms of you can fractionalize assets, you can sort of unlock potentially illiquid assets, open up, you know, a wider pool of investors, or some of just the efficiencies of being able to transfer assets on blockchains and so on. But just talk us a bit more through this idea of the asset-based economy and what that will mean for the UK economy as a whole, sort of UK PLC, as it were.
Well, I'm trying hard not to give anyone indigestion before lunch. Thankfully, they didn't put me in the after-lunch session. Where we are now is an economy which focuses on title or entitlement. Most of you are aware when you put your money in your bank account, it's an entitlement they give you back. It's an IOU. So in the future, when you ask for it, they give it back to you. In some of our digital asset companies, that term upon the time upon which they return that IOU, they return whatever it is you deposited with them, is now unlimited. And most people don't know that. It's in the fine print of the terms and conditions, which have been steadily changed over the last several years. That's disturbing. So when you're moving into a title versus entitlement economy, I'd ask everybody in this room to consider what would they prefer to own? The title of something defended by our courts and our financial systems, or the entitlement of something which says that they'll pay you when they want to. And that's a scary proposition in the macroeconomics that we have at the moment. So we're seeing it around the world at the moment. We're moving to various forms of asset-based economy. Some of these are Zimbabwe, Venezuela, Lebanon. We've seen the challenges and problems that they have there. We're offering another alternative, though, is by taking what is the primary asset of all of us, as my question to start off today highlighted, by taking the primary asset that we all have access to and turning that into a form of money itself. That gives us a level of financial freedom and access to our capital that allows us to invest in our new economies, to allow us to manage our lives properly. And that's very powerful. And that's what we think is coming down the road. To give you some stats on this, we've been looking at State Street, Vanguard, and BlackRock in the States, between those three companies and various other vehicles they're using, they're buying about 26% of all private real estate every month. It's anticipated within the next 2 or 3 years, they'll own 60% of all real estate in the United States of America. When asked the question in terms of where that goes and what is their view of this one, we have a leverage economy, entitlements. Michael Minnelli this morning spoke about the leverage on the balance sheets, 8 to 12%, and how obviously that creates the mechanisms by which we can create and loan money. In an asset-based economy, a lot of that disappears. And by the way, so does a lot of the inflation. So an asset-based economy becomes very attractive. If you look at a post-inflation environment or a post-potentially stablecoin environment, stablecoins being based on fiat currency, if you look at that environment and you're looking at an asset-based economy, assets in a digital asset world are linear. You either own them or you don't. It's binary. And in that type of world, you create that long-waited for sound money that many of us have always dreamed of, but never could work out a way to create. And that, again, becomes very interesting. So our bet as a company is that we're moving to sound money. We're moving to an asset-based economy. An asset-based economy where you can take the very principle, the very assets that you own, tokenize them. Might not be property. Real estate is just one asset. Might be other assets. There is a role for government to play here, and we've been working for last 7 years with stakeholders to make sure we have a top-down deployment of the model that we've created. So that's the prudential, that's the regulatory, that's the treasury, the taxonomy, the jurisprudential aspects, making sure that the asset still has the same laws that always apply to it, continue to apply with it, because I think all of us would really prefer that someone didn't go and spend our house without our knowing. So all of this is very much where we are. And this is a brave new world of which the UK can lead. And as we deploy our model, as we deploy our exchanges worldwide, our target is 20 exchanges over the next 18 months. It's called the London model. So we're flying the flag for London on this one.
Well, I'm sure the Lord Mayor will be pleased to hear that. We've got other policy people in the room dotted around. So, you kind of touched on this when you mentioned inflation, but what are the drivers from the kind of policymaker regulator perspective in terms of supporting the growth of tokenized assets?
It's fascinating once it gets amongst the policyholders, and these are private sessions, so I have to leave names out of it, but rest assured, they've been ongoing for quite some time now. What we're doing offers new monetary and fiscal tools. This is something that our central banks haven't seen, the Treasury hasn't seen for quite some time. Because of what we're doing with real estate, because of the way it moves through our system, it's actually anti-inflation. So it reduces the inflation that we're experiencing in our economy. If you take the M1, M2 increase as being the root cause of our monetary inflation, which is then recognized in our retail inflation. This becomes ever more increasingly interesting to them. And I have to also chime here at this point, and I'm happy to make a public announcement today about this, is that our TPX property exchanges, for the first time, have created layer 1 taxation inside of our topology. Of course, when you talk to the governments and you mention the fact that you can collect tax for them at no cost, whatever their statutory responsibilities are, whatever the authorities they have for that tax, that gets them very excited. For all those who are building, who are working with the stakeholders, I would strongly advise if you can create a taxonomy, if you can create a tax system for them that meets their requirements, not just your own, but their requirements, then you've got somebody, as is in our case, who are willing to promote what we're doing worldwide.
We've got quite a few questions rolling in, but before we come to that, I just wanted to ask a bit about the role of the digital pound and how that kind of plays into all of this.
No, I'm going to get controversial on this one, you know that.
Okay, 1 minute of controversy.
Okay, here we go. So we take a view the digital pound, wholesale model, fantastic. Clearing banks, great. We think there's a fantastic case for that. We think there are elements of this which are very useful in societies as we go. And we have various agencies and groups who are looking at this around the world, not just here. A lot of the centralized authorities are very shy of going retail CBDC for obvious reasons. We think in part of what we're doing is we're moving away from a stable coin to an asset coin having much more firmly established value, transparency, trust, governance, because it's pinned to the actual price of that asset at any moment in time. And we can do that now because our technologies allow us to do that now. And indeed, after this, please come and see us. We'll show you some of the military technology that we're deploying globally to enable that to happen. So we're moving into a different world. I think there are some big issues. There's too much debt in the system. The liquidity is going to start to get squeezed, we believed, as time goes on because of the monetary inflation and the inflation that then is visited. And so all the governments that we've had discussions with are interested to see how we might be able to help them in terms of their future planning.
Well, I'm sure there's a lot of questions that people have, and as you say, you're going to be sticking around the rest of the day with your stand so people can come and hopefully sort of chat to you, maybe challenge some of those assumptions, ask their questions.
Yep.
Obviously, one of the traditional ways of doing this right now is a real estate investment trust. So what are the advantages of what you're doing over a rate?
Okay, so in our discussions with regulators, not just here, but in other countries, we are a UK company, we started here. We found the same thing. The buying and selling of real estate between individuals is not a regulated activity. Peer-to-peer platforms, buying and selling of title, and we define what we're doing not as a token, not technically as a digital asset, it just happens to move like one, but by complicit agreement of the stakeholders that we're working with, they've accepted that it is title of property that we move, and therefore outside of the perimeter of a lot of the regulatory systems in which they sit, by common definition. Having said that, we've struck an accommodation in each and every case. So for our point of view, we fully accept all of this ultimately ends up in collective investment schemes. So the AML and KYC procedures and processes, the monitoring of the asset, the looking at market behaviors on these exchanges is something that we designed from day one, even though there was no technical legal requirement for us to do so. So we built an RIE exchange with a view that it launches as a version 1 peer-to-peer, and in due course, we are due a license by explicit discussion for an RIE, and that enables us to allow collective investment schemes and indeed the institutions to join into the asset class.
I'm not going to read out the whole of the second question because it's long, but if you can just maybe talk to the issue of kind of fractional tokens and what the reserve requirements might be for your asset class.
Okay, so we've had if I've understood the question correctly, I mean, we've had a series of discussions that because of the function of our exchanges, there's no hypothecation, there's no lien, there's no charge. There's no liability on the asset as it moves in and out of our systems and in and out of the payment terminals where we've optimized the technology to work. In that basis, the asset is extraordinarily clean as title of real estate, and it's supported and backed up and seen by governments and by the judicial system. On that basis, we have a view, which the markets will decide and the central banks and the treasuries will decide, that the assets that we've created are actually a tier 1 AAA rated asset. And on that basis is extraordinarily attractive to the balance sheets of a lot of the banks that we're currently engaging with. And certainly we've had discussions in North America with banks that are very keen to place these assets on their exchanges, on their balance sheets. We would make an assertion, which I'd love to discuss with anybody at our stand later, that if Silicon Valley Bank had used our title assets, if we had it fully launched at that point in America, if they'd used our title assets on their balance sheet instead of T-bills, they may well still be here today.
Got a question up the back there. Sorry, there's no mic, but if you can speak loudly.
My voice is probably loud enough. How do you manage a AAA rating without a lien? Because surely if you're releasing value, there must be some transfer of ownership.
You're correct. It's not a transfer of ownership per se, it's a repurchase agreement. Think of a... That's right. Yeah, and it operates, the returns operate like a bond. Yeah. So it's a temporary loan to somebody on their balance sheet. They pay a fee. By the way, for property owners, this is the first time this has happened. They pay a fee back to you, and everybody benefits from the relationship.
And then you probably have to bundle across different asset classes.
Correct. Yes, no, we allow the industry, and this is where I think if people are looking for jobs in the future, you can have a great time bundling these assets for performance.
I think there was a technical question from Slido about which blockchain protocols you're using to tokenize real estate, and is there sufficient liquidity on that network?
Okay, so we've used a BTC fork, proof of work, open and permissionless. We are layer 1 to 3. I think I highlighted earlier, we're a systems approach rather than a point solution. And you have to do this way to meet the stakeholder requirements of jurisprudential and the taxonomy. You cannot have the nation state's properties with a single node operating in the United States with the IRS saying they'll tax the entire transaction if you do that. So all of our systems are self-contained within the sovereign state, and then we have a lot of them as a DeFi model.
There's a question there from Gary.
Yeah, just a quick question, not about technology or anything else, but I think you made a comment, somebody else made a comment, was buying a Starbucks with my house.
Yes, indeed.
Is that a glib comment?
No, it's not. And we're doing that right now. If you want to come and see us later, we'll demonstrate it to you.
I just worry that that's kind of, does that not take us back to 2008? Does that not take us back to things like equity release scandals, where people are using their asset to buy something as simple as coffee?
Okay. There are concerns always there. It's about information and clarity. When we built a lot of this technology, we optimized it for the global payment system. We take a view, I've written an article on this, it's appeared in a few places, that we're at the Uber moment for banking and finance. I think a lot of us are mentioned even today, you know, whether you take a long cycle economics or whatever it is you want to look at, we're in a sea of change. And a lot of these new rules are being established. Access to people's wealth and money and their primary assets needs to be, we think, sacrosanct in the system to enable good economies to work. We don't believe, for example, in the BlackRock model of owning 60% of all real estate. We're Adam Smith's guys, and we like the idea that everybody gets to make their own choices and not BlackRock. And we think that's how you power an economy, by the ownership of assets at the lowest possible level. We also think there's a social good there, because if the society all owns £5 of the Clifford Chance office building each in their wallets, they're less likely to have cause about it. I've seen some very shocking videos over in the States and interviews where the riots that they're having sometimes in some of these cities is because you have people screaming at the reporters saying, "Why are we rioting? Why are we rioting?" It's because we don't own anything. We can't. So as a society, we're about to disenfranchise a lot of our demographics from the ownership of assets. And if we do that, we have to pay the consequences of that. And that might not be very healthy. So back to your question, you're right. You have to always be careful when you're dealing with the retail environment. But to some degree, it's their properties, their houses. And we enable them to buy £5, £10 of title of real estate recognized by the state and to put that on the phone. Now, in theory, that just replaces their deposit account.
Well, that's the same as the financial crisis that we enable people to borrow against their home
Yeah.
values.
There's no borrowing here. There's no mortgages here. This is part of the sharing economy. When you IPO your house on one of our exchanges, you share. It's still their home. They still have a 51%, there's a lot of detail in here which the audience isn't aware of yet. There's always a 51% block of the primary owner occupier who always has that block. And that's designed to protect them. We did a lot of analysis on the CDO crisis, Fannie Mae, Freddie Mac, back in 2008. And it made sure that we built the safeguards in there so this couldn't happen again.
Yeah, I think there's a lot of detail there that people probably want to unpack. I know there was an additional question about what kind of settlement assets you're accepting. Are you accepting crypto, stable coins?
Yeah, so by agreement with our governments in all the deployment sites, we always settle for the purchase of real estate in the nation state's fiat currency. We're there to support their currency, not to destabilize it. Ultimately, however, yes, what we do envisage is an asset-to-asset-based economy where fiat currency only becomes a number, which you count things by, and isn't necessarily the store of value you use to buy things by. And that's quite controversial. As I said, I was going to give you some indigestion before lunch. That's part of what we see coming down the path. And to varying degrees, our communities are starting to embrace that. But let's be clear, some of the points that were made earlier today. More and more people, 50% of the United Kingdom has access to digital assets. And like the Uber article I mentioned earlier, ultimately people always choose which money they use. And it might not be the one that the nation state wants them to use. And I think in terms of what's happening here, in terms of the Digital Pound Foundation, we always must keep sight that it's not just us that choose in these rooms in this city. People will use the one that is the best mechanism for them to store their wealth, to use as a unit of exchange, the most portable, the most valuable, the one that holds its value longest. And that may not be your fiat currency, and we should be aware of that.
So we're running slightly over time, so just to close us out, Anthony, we've got one more talk before lunch to squeeze in. You said you're launching here the London model, so the UK is obviously a strong focus. Is this a global product you plan to launch in other countries? Tell us what's kind of
Indeed.
on the roadmap.
So we have 20 exchanges over 18 months is our target. It's a tall target. So that's launched or launching. London is first, and we purposely designed it that way. The thing we like about London, and I guess it's appropriate sitting in these offices, is we like your lawyers. Thank you very much. Your lawyers, your governance, your transparency, your trust, your years, generations of managing markets. Because if you open a free and open market, you might find it's too free and too open, and then all of a sudden it's not the value that you thought it was. History repeats itself, behaviors repeat itself, and the UK's got a fantastic model for understanding what people can get up to given half a chance. So the systems and the processes here are very good, and that's an export item for the United Kingdom because we're exporting principally to the English common law countries before we go into Napoleonic code. There'll be some lawyers there about to make some money off us, I'm sure there. And before we go into some of the Sharia law, we designed a lot of this to be compliant with Sharia law. And we designed it for other jurisdictions as well. So there's a lot of exchanges to roll out. We are on an Uber Blitz model. Our intention is that this becomes the preferred model of exchange, not just a model of exchange. And we solve, I think, the biggest single issue of tokenization of property is we worked out a model to bring global liquidity to local property without the regulators saying you can't do that. And I think that's very powerful.
Well, it's really, really interesting to hear what you had to say. I'm looking forward to hopefully having you back at a future DPF event to tell us how it's going, what's been happening. But for now, thank you very much for joining us, and also thank you for your support of the event.
Thank you, everybody.